billionaires are hiding money in plain sight. Not offshore accounts. Not crypto. Life insurance. The same product you've been told is just for funerals is being used by the ultra-wealthy as a tax-free personal bank. And insurance companies are praying you never figure this out. Here's what nobody tells you about life insurance. There are two completely different worlds. The world where regular people buy term life insurance, pay premiums for 30 years, and statistically speaking, 97% of those policies never pay out a single dollar. The insurance company keeps everything. Then there's the other world. The world where the wealthy buy a completely different product. Permanent life insurance structured in a very specific way that turns the policy into a wealth-building machine. We're talking about policies that accumulate cash value that grows tax-free, that you can borrow against without triggering taxes, and that passes to your heirs completely outside the estate tax system. But here's the thing that should make you furious. Insurance agents make way more commission selling you term insurance than teaching you these strategies. So the question becomes, why isn't everyone doing this? The answer reveals everything wrong with the financial industry. Let me break down exactly how this works. When you buy a whole life or indexed universal life policy and structure it correctly, a portion of every premium you pay goes into what's called the cash value account. This account grows in a few different ways depending on the policy type. In whole life, you get guaranteed interest plus dividends from the insurance company. In indexed universal life, your growth is tied to market indexes but with downside protection. Here's where it gets interesting. The growth inside this policy is completely tax-deferred. Not tax-reduced. Tax-deferred. Meaning you don't pay a single dollar in capital gains, dividend taxes, or income tax on any of the growth while it's sitting in there. Compare that to a regular brokerage account where you're getting hit with taxes every single year on dividends and capital gains. Now if you want to access that money, and this is the part that makes accountants nervous in a good way, you don't withdraw it. You borrow against it. More on that game-changing strategy in just a minute. Now let me introduce you to a concept that might just revolutionize how you think about money. It's called infinite banking, and it was formalized by a guy named Nelson Nash back in the 1980s. But the wealthy have been doing this for over a century. Here's the core principle. Instead of putting your money in a bank where it earns almost nothing while the bank lends it out at high interest and keeps the spread, you become your own bank. Your properly structured life insurance policy becomes your personal banking system. When you need money for a car, for a business investment, for real estate, instead of going to a bank and paying them interest, you borrow from your own policy's cash value. Yes, you still pay interest on that loan. But here's the mind-bending part. Your entire cash value continues to earn dividends and interest as if you never borrowed a penny. Read that again. The full balance keeps growing while you use the money elsewhere. Banks don't want you understanding this. Why would they? You're supposed to be their customer, not their competition. But hold on. I know what some of you are thinking. Whole life insurance has terrible returns. Dave Ramsey says buy term and invest the difference. Let me address this head-on because this is where the confusion lives. Traditional whole life insurance sold by most agents absolutely does have mediocre returns. You're looking at maybe 4 to 5% annually if you're lucky. And yes, if you took that same money and invested in an S&P 500 index fund averaging 10% over the long run, you'd have more money. Case closed, right? Wrong. Because that analysis ignores three massive factors. 1. The tax drag on your investments eats significantly into returns. 2. The volatility risk means your money isn't always there when you need it. And 3. The ability to access capital without selling assets and triggering taxes is incredibly powerful. But here's what really matters. The ultra-wealthy aren't choosing between life insurance and the stock market. They're using both. The policy becomes their stable foundation, their private bank, while their other investments take calculated risks. Stay with me because the specific structure they use changes everything. But here's what nobody in the mainstream financial media will tell you. The policy you buy off the shelf is designed to maximize the insurance company's profit, not your wealth. The secret is something called a maximum overfunded policy with a paid-up additions rider. Let me translate. When you overfund a life insurance policy, you're putting in more money than required to keep the policy active. This extra money goes directly into your cash value, turbocharging its growth. The paid-up additions rider lets you purchase additional small policies inside your main policy, each with their own cash value that grows immediately. This structure minimizes the amount going to insurance costs and maximizes what goes into your personal wealth-building account. Insurance companies hate selling these because they make less money. Insurance agents hate recommending these because their commissions are lower. This is the dirty secret of the industry. The products that are best for you are the ones they're least incentivized to sell. If your agent pushes back when you ask for this structure, find a new agent immediately. Now let's talk about the tax advantages that make CPAs do a double take. I already mentioned tax-deferred growth, but we're just scratching the surface. When you borrow against your policy, that loan is not considered taxable income. You're not selling an asset. You're not triggering gains. The money just shows up in your account and the IRS can't touch it. As long as you keep the policy active, you never have to pay those loans back in the traditional sense. They simply get paid off from the death benefit when you pass. And speaking of the death benefit, this is where generational wealth really kicks in. Life insurance death benefits pass to your beneficiaries completely income tax-free. But it gets better. With proper planning using an irrevocable life insurance trust, or ILIT, that death benefit can also avoid estate taxes entirely. We're talking about wealthy families passing $10, $20, $50 million to the next generation with zero estate tax. The 40% federal estate tax that would normally apply simply disappears. Think about that for a second. Let me show you exactly how a wealthy family might use this. The Johnsons, a fictional but representative example, are in their 40s with a combined income of $500,000. They're maxing out their 401k plans, but they're hitting a wall because of contribution limits and they're in a high tax bracket. They purchase a properly structured indexed universal life policy with an annual premium of $50,000. For the first 7 years, they funded heavily to maximize the cash value while staying under IRS limits that would classify it as a modified endowment contract. By year 10, their policy has accumulated over $400,000 in cash value. They borrow $150,000 to invest in a rental property, while their full cash value continues growing. The rental income pays back the loan over time. By retirement, they have access to tax-free income through policy loans of $50,000 per year, supplementing their other retirement accounts. When they pass, their children receive a $2 million death benefit completely tax-free through their ILIT. That's not a hypothetical. That's the playbook. Now I have to give you the reality check because this strategy is not for everyone, and anyone who tells you otherwise is probably trying to sell you a policy. First, you need to be able to commit to consistent premium payments for at least 10 to 15 years. If you surrender a policy early, you'll lose money to surrender charges and potentially trigger taxes. Second, you need to have already maxed out tax-advantaged accounts like your 401k and IRA. If you haven't done that, do that first. Third, this works best for people in higher tax brackets now who expect to remain in high brackets. If you're in the 12% bracket, the tax benefits are less impactful. Fourth, you absolutely must work with a fiduciary advisor who understands these structures, not just an insurance agent looking for commission. And fifth, this is a long-term play. If you need liquidity in the next 5 years, this is not your vehicle. The wealthy use this because they're playing a multi-decade, multi-generational game. If that's not you right now, that's perfectly okay. Let's address the critics because I know they're typing furiously right now. The biggest objection is that you could invest the difference in the stock market and come out ahead. And mathematically, in a pure vacuum with no taxes, no volatility, and no behavioral factors, that's often true. But we don't live in a vacuum. Studies show the average investor in equity mutual funds earned only 4.25% over 20 years compared to the S&P 500's 9.85% return. Why? Behavioral mistakes. Panic selling during downturns. Buying high and selling low. The structure of a life insurance policy actually protects you from yourself. You can't easily panic sell. The money is there, growing steadily, regardless of what the market does. For the disciplined investor who never makes emotional decisions, maybe you don't need this protection. But for the 95% of people who aren't robotic investors, having a portion of your wealth in a stable, protected vehicle that you can't easily sabotage isn't a bug. It's a feature. Here's where we bring it all together with the numbers that matter. In a properly structured policy, you can typically access 85 to 90% of your cash value through loans at any time. The loan interest rates are usually between 5 to 8%, often fixed. But remember, your full cash value continues earning dividends or index gains as if you never borrowed. So your net cost of borrowing is often close to zero. When you compare this to home equity lines of credit with variable rates, personal loans with high interest, or margin loans that can be called during market downturns, the policy loan becomes incredibly attractive. Add in the tax-free death benefit, the tax-free access during life, the asset protection benefits in many states, and the estate planning advantages, and you start to see why families like the Rockefellers, the Waltons, and countless others have used these strategies for generations. This isn't about getting rich quick. This is about building generational wealth the way the 1% has been doing it quietly for over 100 years. So what's your next move? If you're intrigued by this strategy, here's exactly what I want you to do. First, evaluate your current financial position honestly. Are you maxing out retirement accounts? Are you in a higher tax bracket? Do you have consistent income to commit to premiums? Second, if you check those boxes, find a fee-only fiduciary financial advisor, not an insurance agent, who can analyze whether this strategy fits your specific situation. Ask them specifically about maximum overfunded whole life or indexed universal life with paid-up additions riders. If they don't know what you're talking about, find someone who does. Third, get illustrations from multiple insurance companies. Compare the cash value projections, the guaranteed versus projected returns, and the surrender schedules. Never buy based on one illustration. Fourth, understand that this is a 10 to 20-year commitment minimum. If you're not ready for that, focus on other wealth-building strategies first and come back to this when you are. The wealthy don't just know different strategies. They execute them with patience and consistency. Now you understand why insurance companies don't want you knowing these strategies. The properly structured permanent life insurance policy isn't just about protecting your family after you're gone. It's a tax-free wealth-building machine, a personal banking system, and a generational wealth transfer tool all wrapped into one. If you got value from this breakdown, hit that subscribe button because we're exposing financial strategies the system wants to keep hidden. Now I want to hear from you. Are you considering this strategy, or did I miss something? Drop your thoughts in the comments. I read every single one.